News broke this week that Kalshi is doubling down on commodities, expanding its market, and unveiling a dedicated hub to trade futures and event contracts. In a world of rising inflation, supply shocks, and volatile energy costs, this shift matters because it changes how everyday investors access raw materials. Kalshi's platform aims to bring transparency to price discovery, reduce counterparty risk, and slot commodities into mainstream portfolios alongside stocks and bonds. For millions watching from wallets and apps, the move signals a broader trend toward democratized risk markets. If corridor risk runs hot, accessible tools can temper uncertainty and unlock new liquidity. Kalshi is not creating a brand new exchange, but expanding the reach of binary event contracts and adding dedicated commodity contracts to the platform. In plain terms, investors can place bets on price moves or weather events, with the hub centralizing listings, risk controls, and education. The expansion means more contracts tied to goods like crude oil, copper, corn, and natural gas, with standardized margins and faster settlement windows. For traders, this lowers the friction of accessing commodities beyond futures brokers. For Kalshi, it accelerates scale while offering a familiar, user-friendly interface used by thousands of retail and professional users. To understand Kalshi's move, you need to trace the idea back to prediction markets and the regulatory path that allowed them to exist. Kalshi launched as a regulated exchange for binary event contracts after gaining CFTC approval around 2020, aiming to democratize access to price movements on real-world events. The broader trend traces to traditional futures markets and exchange operators expanding digital offerings, like CME, expanding micro-contracts, and ETF plays. Investors have long sought transparent, near-term risk hedges outside standard equities. Kalshi's focus on commodities taps a familiar asset class with tangible macro drivers, creating a bridge between retail appetite and institutional risk controls. Early traders are watching Kalshi's commodities expansion with cautious optimism. Market makers are testing new liquidity by listing energy, metals, and agricultural contracts alongside binary outcomes, increasing the mix of hedges and speculative bets. Retail participation often spikes during major macro moves, and the new hub could attract users who previously avoided futures due to complexity. Some analysts note improved price discovery when a dedicated hub lowers information gaps, while others warn that binary-style contracts may exaggerate short-term moves if liquidity dries up. Regulators emphasize risk controls, margin requirements, and clear settlement processes to protect participants. Investors are watching order flow, spreads, and counterparty risk more closely. The expansion touches a wide circle of players. Energy majors and refiners may see new price hedges tied to crude and gas, helping manage volatility from OPEC decisions or supply outages. Agricultural shippers and farmers could use contracts to guard crop margins against weather surprises. Financial intermediaries, brokerages, and clearinghouses must scale risk controls as new products demand more margin commensurate with liquidity. Retail traders gain an entry point through user-friendly mobile interfaces, while hedge funds and prop desks explore portable, near-term signals for event-driven strategies. In short, the hub reshapes exposure across commodities ecosystems. Campaigns around price forecasting could rise in prominence. Beyond Kalshi, macro forces shape every contract. Inflation pressure drives demand for hedges, while central banks grapple with growth versus price stability, tightening in some regions and easing in others. Geopolitics matter, as energy dependency, sanctions, and supply chain frictions influence volatility across oil, copper, and wheat. The dedicated hub arrives as institutions reassess tail risks in commodity markets amid climate policies and steel demand tied to construction cycles. Currency moves and interest rates feed into carry costs, margin requirements, and liquidity expectations. In this environment, digital venues offering clarity and speed gain attention from both sides of the trade. Smart money is watching with disciplined curiosity. Some hedge funds and macro shops explore event-driven allocations using Kalshi's Commodities Hub to gain quick directional bets without traditional futures friction. Pension funds and endowments observe risk-controlled exposure and potential portfolio diversification across real assets. Brokers report rising client inquiries about margin, settlement, and liquidity scenarios, suggesting demand for transparent pricing. Retail outfits, fintechs, and educators boost content around how to structure trades and manage risk. The mood is validation-oriented, a recognized platform pairing regulatory guardrails with a growing suite of commodity contracts. Volatility watchlists and API integrations also improve. Every bold expansion carries risks that could derail momentum. If liquidity is uneven, spreads widen, and execution becomes difficult during spikes, inflating costs for both buyers and sellers. The binary design can amplify short-term moves when events resolve quickly, creating misleading signals or forced unwinds. Regulators remain vigilant around margin, disclosure, and customer protection, and any misstep could trigger policy tweaks that slow growth. There is also the risk that correlated macro shocks overwhelm hedges, leaving portfolios exposed to gaps in coverage. Skeptics warn that novelty can outpace real depth in sophisticated risk management. Audit trails matter too today. Retail investors should approach Kalshi Commodities with discipline and education. Start by defining a small allocation to exposure you understand and use only funds you can lose. Learn the hedging logic behind contracts, test strategies in a risk-free environment, and monitor liquidity and bid-ask spreads during pressurized sessions. Favor diversified baskets rather than single bets, and set rules for entry and exit, including stop-loss-inspired limits. Read product disclosures, review settlement timelines, and confirm margin requirements. Track macro signals, such as energy policy shifts and weather patterns, to avoid over-reliance on a single event. Maintain patience, journal trades, and reassess quarterly. Looking ahead, Kalshi's Commodities Hub could accelerate the mainstreaming of alternative risk markets. If liquidity improves, more contracts could appear across energy metals and agriculture, enabling rapid hedges in response to supply shocks, weather events, and policy shifts. Banks, asset managers, and even corporates may test how event-driven bets align with tactical portfolios, while regulators balance innovation with protection. For investors, the opportunity is clear, but not risk-free. Diversify, verify liquidity, and stay aware of model risk in binary-style exposures. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.